two traders use this one setup to turn $100,000 into $20 million. And it starts with a sentence most retail traders get exactly backwards.
We don't want the high price. We want the right price. The right price is when the stock has gone through that proper VCP characteristic.
The right price. Not the cheap price, not the breakout price everyone's chasing, the right price. That distinction is the entire methodology, and by the end of this, you'll be able to find it yourself. Here's what you'll walk away with. How to count contractions, the shrinking pullbacks that define a VCP, where the pivot sits, where the stop goes, how to size it so a loss costs under 1% of your account, when to sell, which is the part almost nobody teaches, and how to spot a fake VCP. So what is a VCP? Volatility Contraction Pattern. It comes from Mark Minervini, two-time United States Investing Championship winner, and the guy who averaged around 220% a year for 5 straight years. 4 pillars. Pillar 1, Stage 2, first. You only look for this pattern inside a confirmed uptrend, and Minervini defines that with the trend template. It's on screen. 8 criteria, all of them have to pass. The short version, price above the 50, 150, and 200-day simple moving averages, stacked in that order, with the 200-day rising. Simple, not exponential. If that's not true, there's no setup. Stop looking. Pillar 2, the actual pattern. Inside the base, you get 2 to 6 pullbacks, and each one is roughly half the depth of the last. 22%, then 11, then 6, then 3, each low higher than the one before it. And here's what's happening underneath. Every pullback shakes out another layer of nervous holders. Quick flip buyers are gone after the first drop. Break-even sellers are gone after the second. By that last tiny contraction, almost everyone still holding actually wants to own it. Weak hands have handed shares to strong hands. That's the entire pattern. So if the pullbacks in front of you are random depths or getting wider, that's not a VCP. That's a stock going sideways. Different thing entirely. Pillar 3, volume dry up. Volume shrinks with each contraction, and the driest bars in the whole base should show up in that last tightest section. Then the breakout needs volume 40 to 50% above the 50-day average. Real demand, not drift. Pillar 4, the pivot. That's the resistance line across the top of the final contraction. You buy through it, your stop goes just under that contraction's low. And here's how Mark Ritchie II defines a low-risk entry. It has nothing to do with price.
The way I like to define the low-risk entry is so I can know in relatively short order if I'm right or wrong.
Short order, that's the point. The entry isn't cheap. It's informative. You find out fast, and if you're wrong, you move that money somewhere else. Your whole chart setup is 7 things, moving averages at 200, 150, 50, 21, and 10. Volume with a 50-day volume average, and ATR 14, which just tells you what a normal day's move looks like in dollars. That's it. Trade 1. May 2023. NVIDIA gaps up on earnings, the move that kicked off the whole AI trade. Then it does the thing that frustrates everybody. It goes sideways for 32 weeks. And it doesn't go quietly. It hurts people. Twice. August 24th, the stock gaps up, tags 5017 intraday, closes at 4707, reversed the whole day on 1.15 billion shares. Minervini calls that a squat. It jumps, then sits back down on everyone who chased it. 3 months later, it tries again. November 20th, pushes to 50.45, rolls over, closes the week at 48.63 on 900 million shares. Failed again. 2 failures, 6 months of nothing. And here's what separates this method from everything else. The base didn't get worse, it got better.
This is really the first buyable base. Stock has this big run. Obviously, what looks expensive to everybody else is attractive to us because that's when it wasn't ready for a low-risk entry. Well, that's what requires patience and diligence and tracking it.
Patience and diligence and tracking it. So let's count what was actually forming while everyone else got bored. Contraction 1, 50.17 in August down to 39.16 on Halloween, 22%. Contraction 2, 50.45 in November down to 44.93. 11%, almost exactly half. Contraction 3, 50.34 in December down to 47.24 on January 3rd, just over 6. And then January 5th, the entire day trades inside a 2.5% range. 22, 11, 6, 2.5. That's a textbook 4 contraction VCP, and it took 8 months to build. Now the confirmation. Against a 50-day average around 430 million shares. December 27th printed 233 million. 54% of normal, the lowest volume in 5 months, sitting right in the tightest part of the base. Supply had completely dried up.
Because we talk about supply drying up. Right before we bought was one of the lowest volume days in that whole base. So to Marky's point, this is just classic.
Same signature, different stock, different year. Now run the trend template on breakout day, January 8th. Every moving average stacked in order, 10 through 200. Price 27% above the 200-day, which was rising. Every box checked. Numbers are on screen. Here's the trade. Your pivot is 50.45. The top of the last real contraction, the exact price that rejected the stock in November. Buy stop just above. Call your fill 50.75. It closed that day at 52.16 on 642 million shares, 1.57 times average. Confirmed. Stop at 49.35, just under the breakout day's low. Your risk is $1.40, 2.76%. And now sizing, where most people get this wrong. $100,000 account. A 25% position is $25,000, 492 shares. If you're stopped out, you lose $689, 0.69% of the account. A quarter of your money in one stock, and the worst case is under 1%. That's what low-risk entry actually means. Day 1, it closes at 52.16. You're up 2.8%. And already at 1R, 1 multiple of what you risked, never under pressure, not one session. And that's the tell. When a stock charges out of the gate, that's your first sign you might be holding something bigger. Then the selling, which is a completely different skill. January 24th, it closes at 61.25, up 20.7%, 7.5 R. You sell the first third, not because it looks weak, because it looks strong. That sale finances the entire risk. From here, the trade can't hurt you. February 16th, up 43%. Earnings in 5 days. One non-negotiable rule.
You have to sleep comfortably at night on your pillow. We call it the pillow factor for just that reason. You got to sleep comfortably at night with the risk that you have exposed to the market.
Yeah, and if there's one rule, it's never hold an overweight position into an announcement like that, because you're guaranteed at some point to take a massive hit.
So you reduce. You are not overweight into that print. February 22nd, it gaps open and closes at 78.40, up 54%. Second third comes off straight into strength. And then March 8th tells you exactly when to leave. It opens at 94.97, runs to 97.23. At that high, price was 47% above its 50-day. 47% above the 50-day is the nosebleed section. Last third comes off around 86 to 90, or via a backstop under that day's low. Blended, you made about 48.7% in 9 weeks on 2.76% of risk, 17.6 R. And here's the validation. From that 97.23 high, NVIDIA fell to 76.06 by April 19th, 22% gone. The trader holding for the whole thing ate every point of it. You were out and your money was free. That's the version everybody wants to show you. Clean base, clean breakout, clean exit. Trade 3 is a different flavor, and it's the one that'll change how you think about selling. Spring 2026. NVIDIA runs from 164.08 on March 30th to 216.57 on April 27th. 32% in 4 weeks. Textbook stage 2, every average stacked. Now, this is not a base breakout. This is a continuation pullback. Same logic, compressed into 3 days instead of 32 weeks. Contraction 1, 8.4% on 225 million shares. That's the shakeout. Contraction 2, 4.1% on 128 million. Contraction 3, all inside a single session, 2.1% on 113 million. 8.4, 4.1, 2.1. Perfect halving, with volume shrinking 3 sessions in a row to 34% below average. Same signature as the 8-month base, just compressed. Supply and demand doesn't care about your time frame. Pivot is 202.76. Fill around 203 on May 6th, and I'll be straight with you. Breakout volume was only 1.09 times average. That's not the surge you want on a base breakout. Inside an established trend, a continuation pullback doesn't need it. But that's a real difference, and I'm not going to gloss over it. Stop at 195.50 under the final contraction low. Risk $7.50, 3.69%, about 1.2 ATR. 20% position, 98 shares, $735 at risk, 0.74%. Same discipline, every single time. Now watch the exit ladder, because this is the whole lesson. May 11th it closes at 219.18, 2.2 R. Sell the first third, up 8%. May 13th, 225.57, 3 R. Sell the second third, up 11%. And then May 14th, opens at 229.58, runs to 236.26, closes at 235.47. 4.3 R. Price is now 22.6% above the 50-day and 13% above the 21-day. That's the nosebleed section, and it is shouting at you.
If we had a weekly, you could see where the trend then starts to go vertical. We're cinching up a backstop even further. Because now I know that inevitable pullback is, I mean, you could probably measure it right there, Bob. I don't know, 40%. You know, it's getting to the point where the rocket has to come back down. Well, I don't want to ride that rocket all the way down.
Final third out around 233, blended 11.3% in 6 sessions, 3.1 R. And the worst it ever went against you after entry was 0. The stock never traded below your fill, not once. And now the part that makes the whole argument. Watch what NVIDIA did next. 11 straight weeks lower. 225, 219, 212, 205, 199, 190. A 16% gain became a 4% loss for anyone who held for the whole thing. You banked 11.3 and moved on. The exit isn't the afterthought. The exit is the strategy.
And that's why even to this day, if you're 50-50, that's all you want to be shooting for. But the ones that do work, we're looking to make that $2 of profit for every $1 we lost. 2-to-1 traders, and that is the, holy grail, if you will, of profitable trading, is doubling your average wins versus your average loss.
Hindsight is always cleaner than real time, and VCPs fail far more often in a correction than in a bull market. Trade your own plan.
You have to reduce the volatility of your equity curve. And to me, performance is measured on return relative to risk. Everybody just wants to throw out the eye-popping return. They don't want to talk about the risk or, how many times you had to hit the Pepto-Bismol or the bottle in order to get that return, right? And this is where the only way to have your cake and eat it too is to use strength for selling.
If you want the next layer, this exact pattern on 5 and 15-minute charts, which is how Weissman traded a lot of that championship year, that breakdown's on screen. Go count some contractions.
Once you learn it and are competent with it, you'll have the benefit of it for the rest of your life. So, stick with it, stay committed, be focused, and live with passion.